Hello and welcome to the Gold, Goats, and Guns Market Report for today, the 18th of February, 2024. My name is Tom Luongo, and we have a lot to talk about. It seems like, before we get started this morning, I want to talk about a couple of things, a little housekeeping. Seems like y'all prefer your interstitial updates to be done via audio. And I can say a couple of things about that. And I'm glad for all the feedback. Truly, it's a great thing. And I think... Well, my problem with this, I have a number of concerns on all of this, and I've listened to all the commentary, how we can fine tune it, what we can do to make sure that people can listen at a higher rate of speed, or blah 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 blah. So apparently, you can listen to this on the Patreon app on your phone at a higher rate than at whatever speed you want, but you can't do it from the desktop player. It doesn't have that functionality because, well, millennials. Because, I mean, who uses desktops anymore? They're so 20th century. Isn't everything on your phone? So that's one. So, and I would rather not host these on YouTube. Anything, I mean, the less I host on YouTube, the better. But then again, there's always the opportunity later on. I could always turn it into a thing for YouTube later and have it as, content for normies later on to audit. After you guys have gotten a hold of it for a bit. So I've got a number of different ways of handling this, and I'll have to speak to Dexter about it when I get a chance. And so just so you know, for now, I'm going to continue just posting them directly to Patreon when I do them. I don't want to give up the morning munchings as a format per se, because again, I do like turning those into blog posts, and writing is a better form for me of putting my thoughts together. Remember, originally the intention of the morning munching was it was supposed to be an informal kind of, journaling session for me that I just dump my brain onto y'all that, once or twice a week in order to, keep my head in the game and get out of my head all the jumble of all the information happening. And that, and that was a great idea when I wasn't doing 3 to 7 interviews a week, right? And still trying to come up with my normal output. So it's a delicate balance here, and I'm trying to produce as much high quality content for you as possible while not allowing all the other stuff to slip, right? That's the goal of 2024. Dexter and I have talked about this an awful lot recently about, how we can improve our internal processes in order to, produce not just more content, but to improve the quality even further. And this is a very important point going forward. And that includes, improving his output so that, the newsletter is better, the blog posts are better, all the content that we do is better. The podcast is better. My God, if I, my harshest critic is my partner on this, on my performance as a podcaster, which is fine. Like, I'm okay with it. It's just, It's a tough business. It's actually a very tough job. I don't know if you guys realize that. So that being said, we will continue to do a mixture of I will continue to do a mixture of both, the audio content and the written content. I think the audio content is easier for me to spin up. Like if I get, a bee in my bonnet man, I've got 20 minutes and I can, put together a couple of talking points so I can post something up very quickly and try and keep them. I may just try and keep them relatively short. If I only have done one thing outside of the market reports during the week, I kind of feel obligated to talk for at least 30 minutes. But if I'm doing a lot of smaller ones, then you might just hear some like short 7 to 10, 15 minute things come out of me. And I may do that. And that also gives me then the opportunity to cross-post it onto other platforms and yada, yada, yada. So that being said, again, thank you all for the feedback. I appreciate it. I really do. Again, it's your service. So, I'm just the conduit. So let's get started. All right. Yeah. So, yeah. Let's talk about this truckers' revolt that's starting to all of a sudden become a thing here in the United States. So this thing, I don't know if you guys, I'm sure you guys have seen it now. And if you haven't, well, guess what? So a guy by the name of Chicago Ray does a 2.5-minute video from his phone, posts it to Twitter or TikTok or wherever, and winds up on Twitter talking about how he's been on the phone with a whole bunch of other truckers, and they're all going to start denying taking loads of anything to New York. And it's coming clearly straight out as a reaction to the amount of persecution that Trump is being subjected to in the courts. And, the civil suit that just came against him for, $364 million in damages for a crime where there's no victim because the banks all approved the loans, but somehow, overstating what you think the value of your assets are on a loan application is now somehow a crime in America, that we're not allowed to negotiate the value of property. It's just silly. I mean, this is just literal horse shit. And it's like this, of all of the lawsuits against Trump, this one is the most egregious because there's no crime. If the banks didn't like the valuations that Trump put on the property, they can write them down. Okay. And then decide what level of loan they want to write the thing against. So it's not like the banks have, not like there's any objective standard to the value of real estate. So it's all just bullshit. If that got turned into Trump overstated the value of his assets and then used that as write-downs against his taxes or this or that or anything else, well, that's a different story. That's tax. That could be construed as tax fraud or something, some other thing. But this is just nonsense. This is the state of New York saying that Trump is not allowed to have an opinion about the value of his property, and then put that on a loan application to a bank, and then open up negotiations. And we all know how Trump negotiates. He goes for the Zopa. I think the property's worth $94 billion. Well, and then the bank comes back and goes, no, actually, Mr. Trump, we think the property's worth $94 million. And he goes, oh, okay, well, how about $1.5 billion? You know what I mean? It's his goal was to get how about $9 billion? And they come back and go, no, actually, I think it's worth more like 1.5. When Trump's original goal was to get the value, the valuation at 1.2 or 1.3. And invariably, he just plays this game. And somehow now that's illegal. And, he owes the bank damages, $364 million, or not the bank, but the state of New York, $364 million in damages. For what? Wasting a bank auditor's time? I mean, who the fuck are these people? And so it's right for this guy, Chicago Ray and the rest of these truckers to look, because they're not stupid. They can see what this is. Just a bunch of shit made up by a bunch of fucking terrible people. And, it's not like we're stupid out here in the hinterlands. The hoi polloi aren't dumb. They listen. They learn. Truckers have got nothing to do but listen to the podcasts and the radio all day long. It's what they do for a living. They're probably more and better informed than the people who are making our fucking laws or the judges who are adjudicating these cases. Because they all live in a freaking echo chamber so small, as I used to say, we would rent for less than $400 a month on the Upper East Side. It's one of my favorite jokes, by the way, and I'm going to recycle it whenever the fuck I can. So, I can't even begin to understand what this thing is about, but it's been on the front page of Zero Hedge up in the gray zone for over 24 hours. I watched the video this morning before hitting record, and it's got 400,000 views. That article, and the video has got over almost 6 million views. Hell, the last Tucker Carlson interview with Mike Benz has only got 25 million or 23 million, and that is, by the way, absolutely something everybody should watch. That's probably more important than the Putin interview. Tucker's interview with Mike Benz is unbelievable. And I mean, I always knew Mike was a good guy, and I've watched videos of him here and there on Twitter and whatnot, but I haven't really ever delved into anything that he actually knows, other than Oh yeah, I got somebody else out there confirming for me that there's an entire censorship industrial complex in the United States. Okay. And by the way, it's raining outside here in Florida. What am I supposed to do? Like, get upset that it starts to rain in late February? Like, oh, climate change. Like, of course not. But honestly, probably the best 45 minutes or so if you watch it at 1.25. I couldn't watch it anything faster than that. Maybe you guys can. Best 45 minutes you'll spend, this week. Certainly not listening to me, curse into a microphone. So, truly, jaw-dropping stuff. And I was beginning to get a little worried, and then I'll move on in a second here, because these are all these things are related. But I was going to get a little worried that Mike wasn't like fingering the Brits and, Five Eyes and all that stuff. And he just clearly didn't get a chance. He ran into that. He ran into that at around the 50-minute mark. I'm like, okay, he's good. Yep, there he is. There it is. Okay, yep. All roads lead to London. But it's not that. And here's the thing: I want everybody to understand. Again, I'm going to reiterate this point until even the dumbest of you in the audience get it, and you know who I'm speaking, and y'all know who I'm speaking to. Britain is the information pipeline. MI6, Five Eyes, all this stuff is the information pipeline on which all of this terrible policy is predicated. Okay? They offshore it all because our domestic spying services aren't supposed to be spying on Americans. So they have to outsource it. It's a whole plausible deniability complex. But it's all built on the same methods and processes and best practices created over 300 years by those guys at GCHQ and Westminster and 10 Downing Street and the rest of them. That's where this shit comes from. And we've learned it very, very well. And they now have access, even if they only have access, even if they only have, 10 or 15% influence. By God, 10 or 15% influence over the American security state is still bigger than the GDP of the United Kingdom. So think of it that way. Like they get to spend a few $1 million on a bunch of fucking gap-toothed spooks over an MI6 who think they're Alec Guinness. To get billions, if not hundreds of billions of dollars worth of value in intelligence propaganda and intelligence operations laundered through the CIA. It's like the best return on investment in the fucking world. It's better than it's better than the return on Eurodollars at zero bound, because it was funded by Eurodollars at the zero bound. So it's just guys, this is not difficult, right? So, we've all been impressed with video we've seen of the French farmers, spewing manure and stuff on French government buildings. And the French know how to throw a party. I get it. But this ain't even the Canadian truckers' rule, which was very Canadian. Hey, we're just going to show up and we're going to throw a party downtown and, we're going to be very peaceful about it. We're going to be very nice and polite about it. But, fuck you, Trudeau. I get it. It's very Canadian. And I'm taking nothing away from Tamara Lynch and the rest, Tamara Litch, sorry, and the rest of them who did and who lit the fire with this. And I think that fire needed to be lit. It was an unbelievable catalyzing moment for, normal people the world over. Then we see it metastasize into the farmers' revolts in Europe, which are continuing to spread, and they're getting worse. And then, for the globalists, that is. But then when it finally turns around and it becomes the Americans, and it's not some astroturf fucking thing, cooked up in the bowels of Langley, and have a bunch of fucking FBI guys, take their class, with class 2 licenses and get in trucks and say, oh, we're going to go storm Washington. And then, the whole thing turns into January 6th all over again. No, this time it's just a spontaneous and organic uprising by people who've had a fucking enough of this bullshit. Like, I didn't uncover myself this morning just how unbelievably angry and virulently angry I am at the lawfare going on against Trump. It's until I started talking about this with Camille while I was heating up my coffee this morning, and I just started like raving like a freaking lunatic. Yes, more than I normally do. And it just uncovered deep like sense of unfairness and visceral hatred of these people. And to see that sneering, sniveling Mr. fucking Burns up, on the bench in New York, handing down that sentence against Trump, which Trump will tie up in courts. He's not going to pay any of the money, but he's going to get tied up in legal costs that are just stupid. He's going to tie up the New York courts. Other shit's not going to get taken care of. It's just it's all a waste of time. And that's what all of these things are. They're just time-buying exercises. They're just a waste of everybody's time and attention, while these people run around and still think that they have any amount of power left with delusions of adequacy, which they don't. Mike Benz made it abundantly clear that they have lost control of the information space. We own it. All we have to do is stop being so goddamn black-pilled. All it takes is one guy ranting into his freaking phone to let everybody know that the truckers are all getting ready to boycott bringing shit to New York. Oh, you want to sneer? Oh, you stroke of the pen, law of the land. You want to bankrupt Donald Trump with a bullshit $364 million settlement for no freaking crime? Fine, you don't get to fucking eat, asshole. That's it. Done. You don't get to eat. Yeah, no Kobe beef for you tonight when you go to Spago, motherfucker. Like, that's the way this shit's going to work from here on out. And that's exactly what we need to see. Like, you know what? No, fuck you. We're just not going to take our loads to New York. We can ship the shit. There's plenty of demand in other places. As the guy said, he's like, you know what? Going to New York sucks. It's a lot of work. Getting one of these things down the streets in New York and all the rest of it. It's a pain in the ass. I can go deliver to, I can go deliver to hell. I can deliver to Atlanta. It's easier. It's ridiculous. So let's watch this story and see how it develops. Because I think this is not just hilarious, but long fucking overdue. You know what else was overdue? I'll tell you. Because this is hilarious as well. So I'm still working. It's the 18th, guys, and I'm still working on this month's newsletter because I wanted to wait until the Munich Security Conference opened up because I was deathly afraid that she was going to like open up and give us World War III at Munich this year. You had to at least it didn't look like things were pointing in that direction, but you had to bracket for that, and I wanted to wait to see what Harris had to say. Kamala Harris had to say when she was at Munich. And then I read the speech yesterday morning, I started working on the main article for the newsletter on Friday to get some ideas down, and then waited for read the transcript in the morning, read it, and was like, oh, okay, this is going to be fun. Here's my quick and dirty 2 cents. Kamala Harris is no dummy. I'm sorry, she's not. They can make anybody look like a cackling idiot. Okay? I mean, she doesn't help herself with the way she speaks sometimes because she's not any good speaking off the cuff. But, a lot of people aren't, to be honest with you. And, it's just a function of this, tabloid British media complex that we have and the way we're supposed to interact with our leaders. Harris goes to Munich and says all the right words with none of the specifics and no policy specifics that would change state. She walked in. She said, America needs to lead. Isolationism is bad. Blah, 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 blah. We support Ukraine. Hey, the House of Representatives, you need to pass this bill. Yeah, blah. Completely on point, and we're delivering for the American people with, infrastructure jobs and the climate change. And like literally it's boilerplate globalism. But there ain't anything specific like, oh, and we're going to fast track Ukraine into NATO, or we're going to do this, or we're going to support, or we even support any of the bilateral security arrangements that are happening between Ukraine and all of our NATO partners. That was curiously absent as well. So, and even after I started writing about it yesterday, and I got to this point in the article, and I'm like, what do I actually believe about this thing? And well, it's right here. You thought I was going to fall for this shit a second time? That I'm going to be the one blamed for kicking off, for inciting Putin to like nuke Kiev or whatever? No, I ain't doing that. Like I'm your girl, but I ain't your girl. Like, I'm sorry, my knee pads aren't that thick. Like, I'm sorry. Like, they're a little worn. You haven't bought me new ones. Like, no. So, for the first time in a long time, Munich was a complete dud. Zelensky goes out there and just lies about everything. They all, pull the Alexei Navalny story, and they jerk that chain. And then Mike Johnson turns around and calls a recess for 2 weeks. Like, yeah, you know what? Like, you're not going to force a vote on this before Munich. You're not doing that. We're not doing this. The hell with you. We're going to do a 2-week recess, and then we'll talk about this. So, this is the good stuff. This is good stuff. I don't know that we're winning. It feels like we are, but, never in a million years think that these people aren't prepared for something else. The problem, with their next move, the thing is, and this is the thing, going back to, Chicago Ray and the truckers, is that this is a wild card. This is a catalyst. This is the thing they don't have on their freaking whiteboard, dude. Like, I didn't see this at all. And if I didn't see it, and Dexter didn't see it, and they didn't see it. I mean, I'll be honest with you. We're usually 2 or 3 steps ahead of where they are in their flow chart. Whatever the flow chart is up on the whiteboard. And they've got the whole Gantt chart laid out of how they're going to roll these things out. Like, this is literally the way we look at the world. Like he and I, we just kind of do this 2 or 3 times a week in phone calls, and you can just see how this stuff plays, how it's playing out. And then you get this thing. And I'm telling you, once the truckers stop showing to New York and New York just starts browning out, forget it. I saw something on Zero Hedge on the other day, if not Zero Hedge, and it was on my Twitter feed, that New York has lost over $1 trillion in investment with Wall Street and et cetera leaving the city. Now, what did we tell you 3 years ago? I remember in one of the first articles Dexter wrote for the newsletter, he was talking about the exodus out of the blue states and said, we need to start thinking about New York as a museum piece, kind of like London. Well, not London, but we need to think of it as that it's going to be a kind of curiosity that people visit and then go, wow, is that all there is? Huh, okay. Because once the financial money leaves New York, what good is New York? It's expensive. It's hard to get in and out of. It's not a big, it's a port, but, we're not doing the kind of port traffic that we used to. Same thing with London. Like these cities were built where they are because of their access to deep water and all the rest of it. But the minute you destroy that portion of the economy, right, the more you the more you knock out the foundation on which the entire reason for doing business there exists. And all of a sudden we can have the best guys in the world. They don't have to be in New York. This is, for the last 30 or 40 years, the reason you go to New York is because it's where all the best people are. That's in terms of, being able to get access to capital and human or otherwise and whatnot. And people congregated there because that's where everything was. Well, the minute you can hire, really good graphic designers and they're living in a 3-2 in suburbia outside of Phoenix, like the hell. All of a sudden they're half the price because they're not having to maintain the lifestyle of living in New York. Not saying that living outside of Phoenix is all that cheap, but understand the difference. And you realize that for the truckers alone, how much money it costs them just to cross the freaking George Washington Bridge to get into New York City. And you realize, like, dude, you think $17 for a hamburger is expensive? How about $20 across a fucking bridge? All of a sudden, Florida doesn't look all that goddamn expensive. When you realize that, you can drive the turnpike from Wildwood to Miami, basically halfway between like Gainesville and Tampa on the West Coast, the west side of Florida, to Miami for 10 cents a mile in tolls. Maybe 12. They might have raised the rates to 12 cents a mile. 12 cents a mile. It's nothing. Gas isn't even all that expensive on the turnpike. And it's a closed system. So this is all leading to so many of the outcomes that we've been discussing here as a community, and Dexter and I have been discussing in the newsletters and all the rest of it for years now. And the one thing that is hard for me to do, because I just don't have the time and or bandwidth, but I have to remind myself to try and do a better job of, is bringing the newer people into the middle of the conversation. You're all coming into a conversation that's 7 years old. I've been building these arguments and these ideas and these themes for 7 years. I try to, when I write a public blog post and I write about something else that recalls an older post, I do that and I link to that on purpose. It's to help try and get everybody up to speed as to what's going on. I don't do as good a job of it as I should, but in the years that Justin Raimondo used to, I think about this right now, in the years that Justin Raimondo used to write for antiwar.com 3 times a week, he would write the articles, but somebody else would actually go and insert all those links. If you remember reading Raimondo back in the day, like every other word was linked. Like every other sentence had a link in it. Raimondo would just, dash the thing off the top of his head. It was somebody else's job to actually put all the links and the sources and everything else into the posts. Like, I try to remember to do all this stuff. I have to do it myself. I don't have a staff doing that, right? I should, but I don't. So, and I get that comment. And the reason I'm bringing this up is I get that comment from people all the time. I get this comment about, can you go back and explain where we are? And like, oh, Jesus, if I did that, I wouldn't be able to go forward. I would be spending all my time talking about where we were. So, and this is especially true, of course, when we get to the market half of the market report, which is going over the charts and everything else. I have to, when I do this stuff, I want to remind you, I am not using just terms of art anymore. I am explaining what that term of art means when I do so. And you can write it down. What is a 1-bar reversal? What is breaking the previous high? What is this? That's all in there. And if you listen carefully and you, if necessary, jot down some notes, you'll realize that there's only like 6 concepts I'm using over and over and over again. Okay, when I'm looking at like a technical market, when I'm looking at technical analysis, when I'm looking at the bond market and whatnot, yeah, sorry, I'm a former chemist, like jargon falls out of my mouth like it's falling off a log, like Kamala Harris cackles. Like I can't help myself. I do my best not to just talk an inside baseball, but it's very, very difficult. So, and that's also where it as opposed to, and for some of this stuff, folks, this is why we have a private discussion server on Slack for you to ask these questions, because the community can answer these questions for you as well as I can, because they've been around. We've got people here who've been around since the very beginning who will be happy to help you get up to speed. And so the comments here on Patreon and the comments and starting things on Slack and just asking basic questions, seriously, no one is going to get angry with you because you don't know what's going on here. The community here is very, very supportive of people, of trying to get people up to speed. We may be, we may be obnoxious about our views on, the CIA and whatever. But when it comes to actually helping people with honest to God questions about the basics, you won't find a better group of people. And so, as asking me in a private DM, well, I'm not, averse to the idea, and therefore I can, weave it into my commentary here. Don't be afraid to ask questions in the comments, in a comment. Someone will probably get back to you on Patreon or on Slack. Okay. And if you don't have and if you need an invite to Slack, just let me know. Okay. Let's do the charts. I'll get you out of here. So gold. So on Wednesday, we were sitting here going, we got the violation of this low here, which now means we have a downtrend because we've got a series of higher lows, series of lower highs and a series of lower lows. That's a downtrend. You can start drawing parallel lines on charts like other guys do, like Martin Armstrong. I'm not a big fan of that. I never have been. I just like to look at horizontal resistance and support, because highs and lows are where you get emotional extremes in markets. The definition of a high is when the supply of sellers overwhelms the supply of buyers and pushes the price down. That's what a high represents in real, honest to God, everyday practical terms. That's what happened. The price went up to that point and could go no higher because no one was willing to buy at that price, or the amount of people willing to buy at that price wasn't higher than the number of people and the amount of money that they controlled that wanted to sell at that price. And that's why price moves back down. Lows are the exact opposite. That's when buyers come in and go, you know what? We're overwhelming the supply of sellers, and we're going to take the price higher. So once you understand, then you internalize that idea. Reading a candlestick chart becomes an unbelievably simple experience once you get some experience under your belt. And believe me, it takes years to get really, really good at it. But when you take this idea into your heart, you're like, oh, that's why opens and closes are so important, especially for markets that, and almost every market out there other than cryptocurrencies has a defined open and close on a daily and weekly basis and monthly basis, right? They do. So on Wednesday, and today, we have a downtrend as defined by, here's a series of, here's a high, here's a high, here's a high, here's a high. Well, they're all lower than each other. This one was higher than these, so this one had the opportunity to break that trend, but then look at where we closed. We opened here, we went up, we went down to here, we went up to there, and we closed down here. So we closed down here below all these other highs. So guess what? This is a false move. And someone asked me today to discuss the kind of false move that Martin Armstrong's talking about, the coming false move in gold in a private blog post he put out. And it's something I have been talking about, which is that if we get a breakdown below 2,000 on a weekly closing basis, it has to be on a closing basis, folks, then we could see a short, sharp drop in gold. But what will likely happen is that we'll get capitulation, we'll get a washout, where people who are long will capitulate and have to sell, and then they'll feed the shorts, and we'll just get a momentum drive down to, say, 1,900 or so. That doesn't mean that gold is, that's the end of the world or anything like that. It just means that positionally within the markets, there was an imbalance, and traders took advantage of the imbalance in the market to push in the direction they wanted it to go to make money. It has nothing to do with what they think fundamentally of gold. And you have to understand that the easiest way to get people into markets is to talk to them about fundamentals. What are the fundamental drivers of gold? Does it hedge against inflation, or the cost of money, or what is it, right? In terms of gold, if it's a stock, you talk about P to E and yield and price to sales and all this other stuff. And the truth of the matter is that markets don't trade on fundamentals. This is what bothers Dave Collins so much. And I love Dave, and he understands this point, by the way, so I'm not calling him out. But Dave is like my go-to guy for the one who gets frustrated that markets don't trade on fundamentals. But these markets are overvalued. I'm like, yeah, Dave, and markets can stay irrational longer than you can stay solvent. because they don't trade on fundamentals. They trade on momentum and sentiment. They trade on which direction are we moving right now, and what does the market in the aggregate think about this particular stock or commodity or fund or currency or whatever. That's the way it's trading. And then you start to ask yourself, okay, who is in control of this market? Who is most affected by this market? And then when you do that, you start getting into things like, why do I always say, oh, look, the ECB just stick saved the euro or something along those lines? It's because the ECB has a vested interest in making sure that the euro doesn't throw technically bad signals at inappropriate times. That's the value of, that's what I do here, is to read these candlesticks, read the way the markets interact with each other, and then give you the TLDR of who I think is moving the markets in a particular direction. Because again, who's trying to affect momentum and who's trying to affect sentiment. Okay, because if you can, because not everybody thinks the markets operate the way I do. This is what markets just do what they do. They aggregate all sorts of people. They aggregate people with low information and high information, and who are skeptical, and who are normies, and who are dumb money and smart money, and blah 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 blah. The idea of the efficient market hypothesis, which is basically to say that markets are market actors are all efficient. Like, no, they're not. Information dispensation and information transmission is very and unbelievably inefficient and asymmetric. So why would you ever believe that, everybody knows what you know? Are you kidding me? If that were the case, markets would be really, really, really predictable, and they're not. So, long-winded explanation as to why highs, lows, opens, closes matter, because they represent, and that's why markets can do things that they don't look like they should. Well, gold should be trading at $9,000 an ounce, say the gold bugs. Well, that's nice. It's trading at $2,000. Why? Well, because this. Well, yeah. And guess what? They're more powerful than you are. Get over yourself. Stop pissing into the wind. And just buy more and shut the fuck up. If you really believe that gold is worth $9,000 an ounce, why are you bitching at it getting them dropping it to $1,900? Oh, it's really not because you think it's worth $9,000 an ounce. It's because you want it to be worth $9,000 an ounce, because you predicated making X amount of money over X period of time, thinking gold was going to go to $9,000 an ounce, and you're getting demoralized. And you are, in your mind, already spent those dollars that gold represents, and you're getting frustrated by it. Stop doing that. Gold is savings. Gold is stored purchasing power. All it is. So, what's the lesson here? The lesson is, for this week, we didn't get a close below what I've drawn in as roughly the support area on this chart. Why am I drawing the support in here? Well, it's because we got a high here, we got a high here, we got a high here, we got a couple of lows in here, and we got this week's close. We got a low here. Like, there's a confluence of highs and lows, emotional highs and lows, roughly along this price band. And look at where we closed. We didn't close down here. If we closed down here, that would be bad. Now we would move this line down to here and go, that's where clearly the bottom is. And clearly what happened is we approached this low, didn't violate it, and then snapped right back up again. Now you can ask yourself, why? We'll get to more of that in a minute. Again, ask yourself, what narrative did they run on Friday? Thursday afternoon and Friday. Well, on Thursday afternoon and Friday, the euro was trying to break down below $1.07, and the dollar was breaking out to the upside, and all the currencies were, the U.S. dollar index on Wednesday was pushing up towards 105, and so what did we see? We saw a whole bunch of central bank activity to try and prop up the currencies and pull the dollar back, and in doing now, but when the dollar was strong, and the way the dollar was trading, the way gold was trading this week, it was keying off the stronger dollar because people were desperate to find dollars. That's not always the case, but right now it was the way it was trading. You could see it intraday, and that was fine. So that means that if you can't knock gold down and keep the euro up at the same time, because it's all about the dollar. So in order to stick save the euro, we had to let gold pop back above $2,000 an ounce into the weekly close. Sorry. Okay. Now, silver, because I don't believe silver is a precious metal, but an industrial metal, moved in sympathy with oil and copper this week. My three indicators for basically commodity inflation, along with gasoline, but gasoline is a derivative of oil. What you have here, but we had this massive rally in silver into the close this week. Silver got pushed all the way to the breaking point, forming a triple bottom here at around $22, but could never close below $22.50 or so, except for this one time back here. Oh, going back into this is too far. I mean, these are important lows, but clearly there was something else operating back here. But just in the last, 4 or 5 months since the beginning of Q4, has silver's only closed below $22.50 once. The rest of the time it's violated it a bunch of times, but it can't close below it. And then we got so now what's interesting about this is here's our washout bar in silver, which was incredibly overdone, a reaction high, which couldn't break the previous high, and that caused another sell-off. 7 weeks worth of downtrend, and now we're checking for reversal signals. And we get one, and it happened this week, and it's a powerful one. How do you define a reversal signal? Within 2 bars of the last bar in the trend, do we get a movement against the trend? And then we define that movement against the trend as being breaking and closing above the last high in the previous trend, which in this case is a downtrend. So we closed above it. So therefore, this is a bullish reversal signal against the downtrend. It happened within 1 bar. So it's a 1 bar reversal. 1 bar reversals are more powerful than 2 bar reversals because they tend more often than not to have continued follow-through action in the same direction, the reversal direction, to the upside. So there's an 85% chance we're going to get follow-through historically action this week. We're going to break this week's high, or last week's high this week, and we're going to push higher. Now, I want you also to note, we didn't just barely breach this high. We blew it away, and we blew it away into the close late on a Friday afternoon. And note where we closed, which is above the green line, and the green line was drawn into this high and this high. So we not only blew away this high, we blew away these 4 highs here. That's a huge move in silver. Huge move. But we've been disappointed in the past. Go through and homework this week. Go through and look at every time that we've gotten a massive move up in silver, a massive reversal bar. Here's one, here's one, here's one. What happened? Every freaking time. And ultimately, silver's not moved for over a year. Okay? So, finally, we get the breakout, which destroys this whole 10-week downtrend, but we're at $23.50. Stay frosty, folks. This could go up and then immediately roll over 2 weeks from now and plumb this and try this $22 area again. Or we could get some follow-through action and maybe push it up to that high there, which is around $24.50 or so. If we get a weekly close above this high, now we're going to challenge 26. When is that going to happen? Next few weeks. Watch it. We'll see how it plays out, and we'll do the thing. Bitcoin. I have marked on here a consolidation zone. It's a noisy consolidation zone. It's not even really a very accurate consolidation zone now because I changed the scale of the chart to reflect the higher price and forgot to tighten this up. But really, this shaded area should be, you can be from this high here to this low, and note how we traded within the range of this bar for 8 weeks and then finally broke out last week and then follow through again this week. And then this is this morning's trading. So, I mean, this represents like 6 hours worth of trading. It's not a lot. No. But given where we closed last week, we only have a 48% chance of breaking this high, but we have just a 10% chance of breaking this low. Those are important positioning uses for traders who want to be able to set trailing stops as they follow trends higher. Every week that you see this happening, you can move up. If you get a break of a previous high, the possibility of then breaking the previous low, like in this bar here, we broke the previous low and then we wound up breaking the previous high. These are called engulfing bars. They don't happen all that often. What normally happens is we break either the previous high or the previous low, and about 85% of the time, 80 to 85% of the time. And so if you break one, you can pretty much guarantee, I said the operative words being pretty much, that the low for that week is set in stone, is good for you to move your stop up. And now you can say, well, if we break this, then I'll sell immediately and I'll consolidate and I'll win. I'll take these gains. Right. And in this particular trade, to be completely conservative, you would have waited until you were out of the gray zone, bought the breakout on the gray zone, and then we'll ride this higher. And the minute it looks like, and you'll ride this unless and until you get some kind of reversal signal. Market eventually will reverse. And when it gets close to being reversing, that's when you're going to say, you know what, I'm out. And if you want during a run up like this and you're worried and you've made some money, you've made good money, you take a little bit of your money off the table, regardless, even if it goes higher. And this is just good, structured, disciplined trading. And it's the kind of thing that I'm terrible at because I'm emotionally volatile. So I don't do it. I just tell you how to do it. And hopefully you guys can figure out how to do it better than me. And then this becomes the cheapest service you've ever bought in your entire life. And I'm happy being able to be funded to do this, which is what I love to do, which is to analyze markets but not trade them. Brent Crude. Say, I love storytelling. I love teaching. I don't necessarily like doing. And that's my thing. So Brent Crude, here was a breakout 4 weeks ago. Then we got this ridiculous freaking bar where we had a like 3% chance of breaking the previous low, and we did. We got a bearish engulfing bar that was attempting to negate the breakout, because here's your downtrend. No reversal signal here because we didn't close above this high, so that means we traded sideways for a few weeks, consolidated around here. Bears kept trying to push it down, couldn't do so. Bulls eventually took over. We get a breakout bar above all of these highs. I could have drawn a box around this like I did on the silver chart or the Bitcoin chart. And then we get the breakout. And then we say, oh, happy days are here again. We got the breakout. We got some consolidation. We got a breakout. It's a nice pattern. Looks good. Boom. We get follow through. And then they shit hammer the fucking thing. And I'm being crude this morning on purpose. This was an absolute Six Sigma event in the price of oil. It should have destroyed sentiment in oil to the point where it drove the price down into the 60s. As I said, respect my authority. I am Davos. I am the ECB. I am the Biden administration. You will respect my authority. We do not want oil above $80 a barrel. Get it through your fucking heads. That's what this bar says. Without any equivocation whatsoever. Double exclamation points, the whole 9 yards, hashtags, all of it. No. Blow me. No, really. Blow me. That's what these 4 bars represent. That's literally what's been being said right now. Respect my authority. No. Oil's $85 a barrel. You just spent how much money to knock this thing down? Great. This is a classic false move. But it's not the kind of false. This was supposed to be a false breakout. And it's not. Now, I'm not saying that oil's out of the woods or anything, but we did get 2 weekly closes now above the $80 a barrel marginal line. every time oil closes another week above $80 a barrel is another day that the bulls sentiment shifts. The people who are bullish oil but skittish get more bullish. You think, oh, maybe I'm not going to get shit hammered this time. I can put a little bit more money on the table. I can put a little bit more money on the table. Yeah, I think I'll buy another contract. Yeah, I think I'll buy another contract. Yeah, I think I'll buy 5 more contracts. They're breaking the fucking thing down. I'm going all in long. That'll happen when we breach that high. One of the things that I haven't discussed this morning is to remind everybody about time. Well, you can see all this. Oh my God, or they're manipulating the price of oil. Okay, well, what does it look like here on the monthly chart? That's what this bar here represented in December. This was the last bar in December, and the goal was to stop oil in January. So it was in here from closing above 81.54. Why? Here's your 3-bar downtrend, and that would have been a 1-bar monthly reversal, which is more powerful than a weekly reversal because it aggregates more time and more trader activity and more human decisions. Bingo! And they know they pushed it back down below $81 a barrel on the monthly close. But now we're back to 83.50. We get a February close at this level, and that's a 2-bar reversal. Why? It took 2 bars to reverse this bar. 2-bar reversals maintain the trend about 65% of the time. But what happens if it's 3 bars? Well, as I've said many, many times, 3-bar reversals aren't. That's an edge. 65% of the time it's going to continue higher. 35% of the time it's going to reverse. So 2-to-1 pot odds, you're going to go higher versus lower, that the trend's going to continue in the direction of the reversal versus not. It's not a guaranteed bet. It's just 65% of the time. It's like getting dealt pocket aces in Texas Hold'em. By the way, they only win 60% of the time. But that's the best hand in Texas Hold'em with the best win percentage. Well, 2-bar reversals are 65% good. 3-bar reversals are coin flips. 50% of the time they go higher. Well, 50% of the time they go lower. So does that confer any kind of net advantage to you? Do you have any kind of signal? No. Once something's probability in this context drops below 50%, it's no longer an edge. It's no longer an advantage. Now it's no longer. So I say it all the time. 3-bar reversals aren't reversals. Okay, because it took too long and too much energy and too much sentiment and too much momentum. It sapped momentum and destroyed sentiment to the point where I would rather, if we don't break within, if we break in 3 bars, I'd rather we didn't even break at all. I'd rather the market, for example, if it's a market I'm bullish on, I'd rather the market just go down. If the 2-bar reversal fails, hey, trade sideways for 8 weeks or 8 time periods and build a nice big base and then break out. 3-bar reversals are treacherous. So what we have is a big ass fight. This is Chicago Ray and the boys, all puns intended, saying no. Will we get the close we need? If we get a close above 81.54, those of you who are interested in oil, that's all you need to look at this point. If we get the monthly close above 81.50, you probably can add to your oil stock positions, and any oil stocks that have been beaten down, you should buy. The underlying asset is now is now negated the its downtrend. The other thing to note here is this what does this mean? Well, in the bigger context, the bigger context is that low there isn't as low as that low there or that low there. That means we retested this low 3 times and still broke out. So slowly but surely, oil is building a longer term base here with a bullish bias to the downside, meaning the bulls are coming in at higher prices, or the bears are running out of money at higher prices to push the price back down, which is the better way of saying it given the current political context. Patreon request hour. I got 4 this morning. I'm going to do these quick. I do hope that this is the right stock. This is the only CTX ticker symbol that I found on investing.com? If it is, hey, it's a small cap pharma stock that does skincare products. This bar here was a harbinger that the breakdown was coming. There was bad news that somebody got a hold of and on thin volume dumped their entire position. Someone else came back in and bought it back. And then we got the breakdown. This looks like this is a bad news. I'm sorry that I didn't animate this, but this breaks all these lows in here as well. This is a fresh low, and then we haven't gotten a reversal of this bar within a couple of months. So whatever research projects they have, whatever FDA trials they have for whatever it is they're doing, clearly they didn't get it. Is this capitulation? I don't know, but you're waiting on whatever's going to happen here as to whether or not this stock is going to go back to $1 or not. That's what you're hoping for. But the first has got to clear about 60 cents, get back into this range, and then 75, and then it'll break through $1. And if they have a product that they can really sell, and then they'll get there. And if not, someone is dumping either to pick up on the cheap, which you'll start to see in rising volume numbers here, or not. Okay. India closed fund. So this is IFN. This is a closed-end fund that covers India. And so let's start with the points. This is a nice, strong bottom. I like bottoms like this. Like you get a year here where you're just kind of building a base. There's no direction. It's very volatile, but it's all contained within this this tight range between about $14 on the downside and about $16.50 on the upside. We get the breakout and of that range. It's slight, and then we get more of the same action for 3 months, and then it looks like we're going to get a breakdown, and then we get the reversal. So this is kind of a false move, and then the breakout to the upside. This is your long-term resistance area between 2150 and 2150. So if we get a monthly close above that, it's going much higher. You can use Indian stock indexes like the Nifty 50 or whatever to get an idea of what's happening there. So I would look at this in conjunction with the underlying indexes that this fund's holdings best represent, and then just watch the two of them together. Now you have to become an expert in India and Indian stock indexes, and there are a ton of them, and what they mean relative to the Indian market. I don't know this off the top of my head. Okay. But it looks good. 8.5% yield. The earnings within the fund itself are strong, meaning, the fund is a business and it's priced at around 10 times earnings. Strong. Meaning it's generating revenue off of dividends and assets that are an asset appreciation that's equivalent to a PDE of around 10, which is cheap. Maybe a little expensive for foreign stocks, but it's relatively cheap. And Indian stocks are defying the gravity of emerging markets in general, are underperforming developed markets. And so that's also an interesting sign. So it's an interesting play here. I like it, by the way. Guns and Nutters. We have Northrop Grumman. This was a false move up, classic false move up. We get a volatile breakout, and then it goes up. It hits a wall and then immediately collapses and then finds a new trading range here. We have a fragile bottom here. This looks like consolidation, but it's really not, because we keep violating the low to the downside and not closing above the previous highs to the upside. It keeps, every time it gets above about 475 or so, it just gets sold. So I would say this is a fragile bottom, because the top of the consolidation zone looks good, but the bottom keeps failing, especially these 3 bars here. So was this overdone? And that's why we got this big move here? Maybe. What I'd say is really, really ugly formation here. This is a low yield stock. It's now trading at a PDE of 33. And if Congress is, going to start drying up the money, it's got to come from the military industrial complex. Okay, I forgot to change the ticker symbol here. I'm sorry about this. This should be ticker symbol LOAN, or loan. This is not 3M. This is what I'm going to say here is this bottoming pattern here is clearly praying for a Powell pivot. They're not getting it. This is a company that does secondary commercial real estate loans, meaning for renovations to and resell and get properties up ready for rent after the original mortgage has been paid off. And it's in New York, New Jersey, and now Florida. And I think their Florida pivot is the only thing holding this thing up. And maybe that's a sign of a well-run company. What I'm going to tell you is I'm looking into the balance sheet on this company, because this is basically this is a proxy for commercial real estate. They've got a high long-term debt to equity ratio. And remember, this is a classic shadow bank, right? They make loans, right? But they're not a bank. They're a non-bank lending firm. Okay. So their equity, their assets are loans, and their liabilities are their cash flow, right? So they are very vulnerable to asset revaluations and loan servicing degradation. They've got a strong yield as of right now and a PDE of about 10.5. They're likely shifting as much of their portfolio as possible out of Manhattan and into Miami. I would hope they are. But you want to watch the March earnings report, which is on March 18th, very closely, and look for balance sheet degradation. It hasn't shown up yet. Revenue has been solid and earnings are up. And that's all the way through the latest quarterly report. And I don't know anything else about this company other than what I looked at in 5 minutes this morning. If you know the company better than me, you think they're well managed, and you think that 9.5% yield is safe, mazel tov. You've uncovered a nice bond in this market. I don't think that the stock is going to go anywhere, but you've got a nice bond at 9.5%. If, however, you think their clients are going to be in trouble paying back these loans because they can't then sell the property that they've renovated or rent the property that they've renovated, then this stock could be very dangerous. So downtrend, reversal signal, no reversal there. And as long as we don't close below that low this month, this reversal signal is still good. But for how much? Where's it going to go? $6? So this is going to be the question. But if this reversal bar gets reversed in February, meaning we got to close below this low, this company's in trouble. And somebody knows. Since Wednesday, the U.S. yield curve didn't move very much, but I don't think I actually showed these curves on Wednesday. The SOFR futures curve moved a lot on Thursday. It was hilarious. So I want you to note something. So this is where we were. The green line is where we were on New Year's Eve at the height of, oh my God, the Fed's going to cut 7 times in 2024. This is where we were on my birthday, basically the day before my birthday last week. Notice how far we moved in 5 weeks. This is where we are today, a week and a half later. We're all the way back to basically to the SOFR futures curve we had in September, which is now pricing in just 5 rate cuts. Well, not even that. So it's pricing in 4 rate cuts because we're at 5.5%, 4.4. 4 rate cuts. Well, short term, the short end of the yield curve is trading at about 5.4%. And they're thinking we're going to be at 4.4% at the end of the year. So it's very giving back 3 rate cuts. Are we going to give back 2 more? 3 more? We're going to get a hike? What happens to the SOFR futures curve if somebody thinks that Powell's going to hike? Remember, inflation came in hotter than expected before we expected it to. And that's why this is here. March rate hike is off the board. And on New Year's Eve, we were looking at a 50 basis point cut in March. And now we're flat. Are we going to get the same thing in June? Are we going to get a replay of 2023? Because I did the same friggin' song and dance beginning of 2023. And then here's the yield curve. Here's where we were at near the end of the year. Here's where it is today. The bear steepener trade has worked out nicely. And what I'm noting now is that the belly of the yield curve is pushing up, and Yellen is beginning to lose the 2 and the 3, and they're really trying to hold down the long end of the curve. And I expect the 10-year to push higher soon. U.S. dollar index wound up closing at 104.3 because the euro got stick-saved into the close, which pushed gold up and oil into the close. Chinese yuan is now flat for weeks now, hasn't moved. The yen is still sitting at 150, and the Bank of Japan has not intervened. The Japanese 10-year bond closed at 725. Copper broke up a little bit by 10 cents to 382 a pound, and gasoline futures are 233 a gallon. Interesting. The Dow. In the Dow, we have let's just go through this. We had a big, nice run up. We had a kind of ugly consolidation pattern here. This is what's known as a bullhorn, where we have higher highs and lower lows, but then we get the breakout, and then we go up, and now we've got a same kind of thing happening here, where this is where look at the width of this bar, right? The range of this bar. We broke the previous high and the previous low we got, and then we have a breakout, an inside bar where we break neither the previous high nor the previous low. Then we get an engulfing bar back to back. These are 2 low probability events back to back. Inside bars are 10 to 15% of the time. Engulfing bars are 3 to 5% of the time. Outside bars like this one are 80 to 85% of the time. Depends on the issue. And you can actually do the math for the Dow versus gold versus this. Everybody's a little different, but the general gist is around 80 to 85% of bars are outside bars where you break either the high or the low. 10 to 15% of bars are inside bars. They happen more often than engulfing bars where you break both. Meaning the markets will tend to, tighten up, and volatility will tighten up far more often than it will explode. Okay. And for the most part, U.S. equity indices were the losers for the week. The Dow was basically flat. The NASDAQ was off 1.5%, but the DAX was up. The Eurostoxx 50 was up. The Nikkei was up again. We like that. And emerging markets were up for the second week in a row versus the Dow. So again, the Dow isn't going to win every week, but as long as it continues to do what it's doing, given the fact that the U.S. dollar moved up this week and stocks were flat, it's actually kind of good. So, all right, that's what I got for you this morning. I think this was a long one, but I had to do some maintenance for the new members of the audience, and I think it was necessary. So with that said, I'm out. You guys be well. You take care. We'll talk soon. Probably Monday or Tuesday, I'll probably throw something up for us to talk about. All right? Be well. Keep your stick on the ice.